Hello everyone, this is Himanshu Sharma, and the topic that we're going to cover today is what is term insurance and what are its benefits. So first of all, let us understand what is insurance. So in an insurance agreement, you have to pay a certain amount which is known as premium to the insurance company, which in turn ensures you that in case of any mishappening, a certain amount will be paid back to you. For example, in case of health insurance, whenever you get hospitalized, so all the charges of hospitalization are being reimbursed by the insurance company. In case of car insurance, whenever your car gets damaged, so all the repair and maintenance that is required is reimbursed by the insurance company. So similarly, in case of life insurance, the insurance company assures that it will pay a certain amount to your family members in case of your death. So basically, it covers the risk of your life. Among other insurance policies, term insurance policy specifically covers death benefit. That is, the sum assured will be paid to your family only in case of your death. But there are other insurance policies also, like endowment policies, where for example, if you set the tenure to 60 years, till 60 years you're gonna pay premium, and in case of your death before 60 years, the insurance company is gonna pay you, and in case you continue to live after 60 years, then also the insurance company will pay you a certain amount. So these type of insurance policies in reality are not absolute insurance policies, because they are the merger of two separate financial products. That is, one is insurance and another one is savings. Because when you pay a premium for such endowment policies, for example, let's say you're paying 1 lakh rupees, then you can say that 90% or more amount is going into savings, and only 10% of your premium is used as a real insurance. So the amount that goes into savings, you can also save it by yourself, and you can give it to mutual fund managers who are much more qualified and experienced than the insurance companies to manage your funds and save your funds to get a higher return. So if you want to cover maximum financial risk in a most cost effective way, then term insurance will be better than normal insurance policies like endowment policies, because here the premium will be far less than the normal insurance policies. In case of term insurance policies, for a sum assured of 1 crore rupees, and if you are 24 years old, you just have to pay around 10,000 rupees only. So it's that cheap. I also came across one article online which showed the difference between the premium paid in case of term insurance policies and endowment policies. So you can see the difference here in terms of premium, how stark is the difference. So the amount here may not be accurate, but you can get an idea out of it that in case of endowment policies, how much more you have to pay in comparison to term insurance policies. Since life insurance is done to cover the financial expenses that your family is going to incur in future, and also the liabilities that you're going to incur, so in order to cover such a huge amount, that's why term insurance is recommended, because it can cover huge sum assured for just 10,000s or 20,000s or 30,000s of premium. So that's why term insurance will be better than the normal insurance policies, which will go in lakhs. And speaking of its importance, term insurance and health insurance should be one of the first financial decisions that a person should take as soon as he starts earning. While choosing your insurance company, first consider the financial stability of that company and also the claim settlement ratio of that company. That is, out of 100 people, how many people have actually got the claim. For example, there are companies where 99% claim settlement ratio are there. So those are considered good companies, and you can take insurance from them. While choosing your insurance policy, there are certain add-ons which are called as riders. When you select a rider, you have to pay a certain amount over and above your premium for some extra features. For example, there is a waiver of premium rider, in which what happens when a person opts for this rider, he has to pay an extra amount every year or monthly or whatever payment schedule he chooses. Then there's an additional add-on that he gets, that whenever he'll get severely disabled or severely ill, then he'll not be required to pay the future premium. There's another rider called accidental death benefit, wherein a person if dies through accident, he'll get an extra amount over and above his sum assured. So these are some examples of some riders, so you can choose accordingly. While choosing your insurance policy, you have to ascertain the sum assured. Sum assured is the value of the claim that you'll get in case of any mishappening. So in order to ascertain this amount, there are various calculations. Let me give you an example. For example, if you are 30 years old and you're taking an insurance policy for the next 30 years till the time you turn 60 years old. So for the next 30 years, you have to estimate an amount that what will be the expenses that your family is gonna incur for the next 30 years. Add to that any future liability that you have to pay. For example, you have car loan or home loan, anything like that. So outstanding amount right on the date when you're taking the policy, you can add that liability to the amount as mentioned above, the future expenses. And you can also add any financial goals that you have, like child's marriage or child's education. So you can also add that. So you will get a rough figure that what should be the sum assured that you should get an insurance for. And if you don't want to get into such calculations, you can go by the thumb rule. Like for example, if you're in your 20s or 30s, that is you're starting early, then you can take the sum assured as 20 times the value of your annual income. So for example, if your current income is 10 lakh rupees per annum, then multiply it by 20 times, that is 2 crore rupees. So you can take sum assured up to 2 crore rupees. It depends upon whether you want to be more secure or less secure. So you can increase or decrease that amount, but it's according to the thumb rule. And if you're taking the insurance policy at a later stage in your life, then you can multiply your annual income by 10 and you can get a considerable amount for your sum assured. And the best advice that I can give you is the earlier you start, the better it will be. For example, if you're 24 years old and you want to get a sum assured of 1 crore rupees, then you just have to pay around 10,000 rupees per annum and you'll get insured. So the premium amount will be so less that you don't have to incur so much of premium. Now let's discuss the tax benefits of insurance policies. The first tax benefit will be the ATC deduction that you get when you pay the premium to the insurance company. According to this section, whenever you pay premium to the insurance company, then up to 1.5 lakh rupees per year, you can claim a deduction out of your taxable income. In simple terms, your income as per income tax will be reduced by the amount that you pay to the insurance company. For example, if you have annual income of 10 lakh rupees and you pay an insurance premium of 50,000 rupees, then 9,50,000 will be considered as your annual income by the income tax authorities, and according to that, the tax will be calculated. And the second tax benefit that you will get in an insurance policy is under section 10, subsection 10, capital D. According to this, whenever you will get a claim amount, that is when your policy matures, then upon maturity, when you will receive the amount, there will be no tax on you. You will not have to pay any tax, and TDS will also not be deducted. In order to avail these tax benefits, there is a condition. The condition in simple terms is if the premium that is payable each year is very high in comparison to the sum assured, then you will not get the tax benefits. And if technically speaking from the point of view of law, then if the policy is issued before 1st April 2012, then if the premium in any of the year is payable above 20% of the sum assured, then section 1010D exemption will not be applicable. And in each of the year where the premium is more than 20% of the sum assured, ATC deduction will also not be applicable. For example, if the sum assured is 1 crore rupees and in any year the amount of premium in any year is more than 20 lakh rupees, then you will not be eligible to get the exemption when the claim will be settled. And in each of the year where the premium is more than 20 lakhs, ATC deduction will also not be applicable when you pay that premium. And similarly, if the policy is issued after 1st April 2012, then the 20% limit is decreased to 10%. That is, if in any year the premium exceeds 10% of the sum assured, then section 1010D exemption will not be available. And also in that particular year in which the premium is more than 10%, then ATC deduction will also not be available. There's one more condition. If the person suffers from severe disability as mentioned in the Income Tax Act and the policy is issued after 1st April 2013, then the limit of 10% will be replaced with 15%. Rest of the conditions are same. So basically these are the conditions that are required to be fulfilled in order to claim this exemption and deduction. None of the conditions that I have mentioned will be applicable in case of death of the insured person. That is, in case the death occurs, then even if the premium is more than 20% or 10% or 15%, whatever it is, whatever the case may be, then also there will be no tax implication for him. The whole amount will be exempt in case of his death. So practically speaking, the conditions that I have mentioned right now will not be applicable in case of term insurance, because the premium in these cases are very low. So it will be less than 10%, 20% or 15% of the sum assured, as the case may be. So you will get the ATC deduction anyhow, most probably. And along with that, the exemption of the claim at the time of death will also be tax free, because in case of term insurance, the amount is received only upon the death of the insured person. So these conditions will not be applicable most probably in case of term insurance. You can also get this ATC deduction that I have mentioned in case you take the insurance policy in the name of your spouse or your children. So I suggest you to take the insurance policy, the term insurance policy, as early as possible in order to get the benefit of very low premiums. And these days taking insurance policy is very easy. You can compare all the companies and their claim settlement ratios and the premiums on one site only. So I recommend you to take the term insurance policy. And the medical tests are also done at home nowadays, so you don't need to go out of your home to get the insurance done. So that's it for this video. I hope you found this video useful. Please hit the like button if you really like this video and share it with your friends and family members. That's it for today. This is Himanshu Sharma. Have a nice day.